Think of a movie zombie. It's not truly alive, it's not fully dead, it just roams around looking for blood. Now look at your stock portfolio. You think every corporation you're invested in is alive and healthy? You are dead wrong. There are literal financial corpses trading right now on the stock market. They are called zombie companies, and they are quietly eating your hard-earned investments alive. A zombie company generates just enough cash flow to cover basic operational costs like rent and payroll, but when it comes to its massive mountain of debt, it can only afford to pay the interest. It can never pay off the actual principal loan. The business is biologically dead, but it's kept on life support by banks just to keep milking the interest. This means zero dividends for shareholders, zero growth, and no future. It's a complete value trap. So, how do you spot a financial zombie before it kills your returns? First, look at the age. New startups naturally take debt to grow, but if a company is older than 10 years and still not expanding, you need to be careful. Next, check one critical metric, the interest coverage ratio, ICR. Divide their operating profit, EBIT, by their interest expense. Interest coverage ratio equals EBIT divided by interest expense. If this number is less than 1.0, danger. It means the company is literally losing money just to stay even with its debt. An old company stuck in this loop for years is a verified financial zombie. Protect your capital, stay educated, and hit subscribe for more raw financial truths.